Hello, good evening. How are you? I hope you guys are doing well. Okay, so let's start. Today's the third sitting that we're going to do over here related to the taxation, and we are again going to cover up the exam kit over here today as well. And primarily, we are going to look at the CGT over here, and that is the capital gain tax. So let's start, and here we are. First question over here, Albert and Victoria. And here we are. Okay. Now, Albert and Victoria. On 12th February 2025, Albert sold a house for 840,000, which he had owned individually. The house had been purchased on 12th February 2009 for 222,900. So we have disposal of a house over here, which was purchased back in February 2009. Throughout the period of ownership, the house was occupied by the Albert and his wife Victoria as their main residence. Now, one quarter of the house was always being used exclusively for the business purposes by the couple. So, for the tax year 24-25, Albert is a higher taxpayer and did not make any other disposals of assets. So, for the tax year 24-25, Victoria had taxable income of 21,440 and chargeable gains on disposal of 3,000. So we have this Albert and Victoria over here, right? And typically speaking, if we talk about, we are going to have the adjustment related to this. So if I scroll down over here in the point number one, the question's requirement is that what is the amount of the private residence relief available on the disposal of the house by Albert? So private residence relief is something that we can try to look up over here, right? And for that, if you go into your tax table, I just want to see one thing over here. We have the inheritance tax over here. We have the capital gain tax. Okay. Now, overall speaking, if we talk about as far as the tax rates are concerned, I just have to copy up these so that I can show you over here. Here we go. So these are going to be the relevant for us, the capital gain tax rates, right? So residential property, and these are the normal rates over here. And Albert is a higher tax rate payer over here. So basically, the first question is asking that what is going to be the amount of the private residence relief, which is going to be available on the disposal of the house. So technically speaking, we have sold the house for 840,000. It was bought for 222 over here. So the private residence relief is going to be restricted to the amount the house was used as a private residence, because 1/4 of the house has always been used for the business purposes. So technically speaking, for that part, the PRR cannot be calculated over here. So we are going to simply have it as 222,900 minus uh 840,000 into 3 by 4. So we are going to get this 462 over here, right? Sorry, I have written it the other way around. This was plus, this was minus. Okay. So 462,825 is what we are going to get over here, and this is going to be restricted to this amount over here. So this is going to be the amount restricted for the PRR, the private residence allowance. That's going to be over here. The reason being, if we talk about the 1/4 of the house or the 25% of the house has always been used exclusively for the business purpose. So for the business purpose part, we can't claim as far as the private residence allowance is concerned, right? So this is what we are going to have over here. Now, the second part, if I go, Albert's brother Ernest has told Albert that it would have been better to have transferred the 50% of the ownership of the house to Victoria prior to disposal. Which two of the following statements are correct over here? Okay, so technically speaking, his brother has advised him that if you would have sold or you would have transferred the 50% of the ownership to the Victoria, then what would have happened over here? Number one, the transfer to Victoria would have been at the nil gain or nil cost over here. Now, if we talk about this one over here, this statement, if I go for this, then I can, yeah, yeah, this is something, this is true, because the transfer between the spouse or the property, this is always at the cost to the couple. Like, the original cost of the couple is concerned, this is always at this point, because we don't calculate the gain or the profits while transferring the property between as far as the couples are concerned. So number one statement is true over here. Then the second one is private residence relief available would not have been available in relation to the Victoria's gain on the disposal of the house over here. So private residence relief available would not have been available. If we go back into the Victoria, Victoria had a taxable income of 21,440 and made chargeable gain disposal of 3,000. So why wouldn't, the Victoria's gain on the disposal of the house, the relief is not going to be available? The relief is going to be available over here, right? It would have enabled her to claim for as far as the relief is concerned, right? So this statement is wrong, saying that the relief is not available to her, and then the amount of the capital gain tax that would have been saved is 3902, and then the amount of the capital gain tax that would have been saved is 976 over here. Now, technically speaking, we will have to calculate the gain falling into the uh taxable for Victoria would have been, this is going to be her basic rate of tax. I mean, basic rate bracket. I mean, if we see over here, she has an income of 21,440 taxable income. So basic tax is 37,700 minus 21,440. Then that's going to be 37,700, 21,440. We are going to get this 16,260 over here, right? So lower residential rate is what we are going to apply over here. This is the residential property, and the lower rate is basically at the 18% and 10% over here. And if I go for, okay, so we are going to have the lower residential rate over here, and that is going to be 16 to 60 into 6%, right? And 6% is basically the difference between the tax charge to Albert and the tax charge to Victoria. right? Now, the tax charged to Albert, if I go because of the higher rate, is 24%. And this is going to be the percentage over here. And tax charge to Victoria, that is 18%, right? So technically speaking, the difference 24 minus 18 is 6%. So 16 to 60 into, oh, sorry, 16 to 60 into 0.06, we get 976. So technically 976 is something that would have been saved, because over and above the rest of the amount that we have, we would have been charged tax at the higher rate. So this is the saving which we could have extracted over here, right? So this is the main saving that we could have gotten over here, right? So moving ahead from here, the next point that we are going to have, now we have the Charles, and then we have the shares to Daphne over here. Now we have to go and read about Charles and Daphne, and this is on 23rd October 2024. Charles sold $4,001 ordinary shares in Restoration PLC, a quoted trading company, to his daughter Daphne for 20,000 when they were valued at 31,600. Gift holdover relief is not available in respect of this gift. Okay, so gift holdover relief is something which is not available in respect of this gift over here. The company has 4 million. The company has 4 million £1 ordinary shares in issue. Charles has never worked for the company, but definitely has worked for the company for the previous 5 years. Charles acquired his shares in the company as well as on 1st March. He purchased 20,000 shares. And then on 20th July 2020, he purchased further shares for 27,800. And then on 4th April 2025, Daphne sold a painting for a gross proceeds of 5,300, and the painting had been purchased for 13,000 in September 2008 over here. And Daphne incurred the auctioneer fee of £300 over here in relation to as far as the disposal is concerned. Now, the third point is, what is the allowable cost used in capital gain tax computation on Charles shares to Daphne as far as is concerned? I'm gonna go over here and solve here, and then I'll put it like downwards. Number one is we are going to calculate the number of shares, and then we are going to calculate their cost over here. First thing first, if we look over here, Charles acquired the shares. So on 1st March 2006, he purchased 20,000 shares for 19,800. Then he purchased on 20th July 2020 further 8,000 shares for 27,800. So, why is it written as 4402? He purchased on 20th July. Why is it writing like this? Weird, huh? Okay. Okay. 20th July 2020, he purchased the remaining shares over here, and the total amount is going to be 28,000 over here, and then the total amount is going to be 47,600 over here, right? Now, As far as the disposal is concerned, he made the disposal on 23rd October. October, right? And on 23rd October, he has sold his 4,000 shares over here. So basically, these 47,600, this was the amount for 28,000 shares, out of which 4,000 shares have been disposed of, right? So I will minus this 4,000 from here, and this is going to be 47,600 for 20,000 each. So one share is going to cost 6,800, right? So the question asks that what is the allowable, the base cost used in the capital gain taxation. So this is going to be the base cost that we are going to use in the calculations over here, right? So this is going to be the base cost that we need to put in over here, right? Because we will average out and we will try to calculate the overall, the value for the 4,000 shares which have been disposed of over here, right? Okay. Now moving ahead from here, if we look over here, as far as the point number 4 or the question number 4 is concerned, it asks that which of the following are the valid reasons why the gift holdover relief was not available on the sale of shares to definite, because it said over here in the scenario that the gift holder relief is not available in respect of this gift. Now, if we talk about, as far as the gift holdover relief is concerned, we just have to, rememorize about, or we have to just recall about the rules that we have for the gift holder relief is concerned, because overall saying the donny basically, like, for paying for the asset, it does not prevent the gift holdover relief from being available. But if the amount paid exceeds the cost, if the amount paid exceeds the cost to the donor, then obviously speaking, the gift holdover relief, it has to be restricted so that any actual capital profit made by the donor at this time of the sale will be immediately chargeable over here, right? So overall speaking, if we talk about this one, these are the valid reasons over here. So the charge has never worked for the company, so it's not a valid reason for the holdover relief not being available or something. Definitely paid charge for the shares. No, it's not a valid reason as well, because technically speaking, if we look over here, I can't see over here definitely paying for it. And then the Charles did not own at least 5% of the ordinary shares and the voting rights in the Restoration PLC. Yes, this is something which we can bring over here, because overall speaking, there's a requirement of a holding of 5% of the shares for the gift holdover relief to be available if the shares are in a quoted company. In a quoted company, if you have, then you can have it over here, right? So over here, our holding is basically, I mean, that's just 28,000 shares out of the total, the shares of the company. I did happen to read somewhere they were 4 million or something. And the company has 4 million shares over here now. So we just had 28,000, which is not equivalent to the 5%, right? So this is going to be wrong over here. So yes, this is something which we can say that it's a, valid reason. It's a valid reason why, the holdover relief is something which is not available over here. Then, what is definite allowable loss, if any, in respect of the sale of the painting on the 4th April? Now, if I go for the sale of painting in April 2025, okay, on the painting sold has a gross proceeds of 5,300 now. So I am going to assume if the proceeds are less than 6,000, I assume that the deemed proceeds over here are for 6,000, right? If they are less than 6,000, I always assume that they are going to be the 6,000. And I have the cost of disposal. So I had to pay the auctioneer fee of 300. So I will have my net proceeds of 5,700 over here. Here we go. And then I am going to less the cost over here. And purchase for 13,000. So I'm going to minus this 13,000 over here. So the capital loss liable is going to be 7,300 over here. So that's going to be 7,300 over here, right? Okay. So that is how, this question has to be tackled and all. Now, moving ahead from here, we have another question over here, which is of the Zoila company. Okay. Now, Zoila's capital gain tax liability for the tax year 24-25 is calculated as follows. We have the ordinary shares in minor, ordinary shares in major, annual exempt amount 3,000. So we have this total over here. Capital gain tax is at 10 and then at 20. So this is what we have over here. Minor Limited is an unquoted trading company with an issue share capital of 200,000. Zola has been a director of this company since 1st April 2018. Then on 20th June 2024, Zola sold 20,000 of her holding of 45,000 shares. In Mile Limited, she had originally purchased 22,500 shares on 15th August, 417,000. So shares were actually bought on 15th August 2022 for 117, and now they have been sold. Okay. Then on 15th December 2022, Mile Limited made a 1-for-1 right issue. Zola took up her allocation under the right issues fully, paying 7.40 per new share issued as well. Okay. Then Major PLC is a quoted trading company with an issued share capital of 2 million. Zola has been an employee of the Major PLC since 1st November when she acquired the 16,000 ordinary shares in the company. Then on 6th March 2025, Zoila sold her entire holding of the ordinary shares in Major PLC to her son for 152,000. Okay, so now she has sold the shares to her son for 152,000. On that date, the shares in the Major PLC were quoted on the stock exchange between 9.62 to 9.74. Zora will not make any other disposals in the foreseeable future, and her taxable income will remain unchanged as well. So, number one, why did neither of Zoila's share disposal during the tax year 24-25 qualify for the business asset disposal relief? Business asset disposal relief over here. Now, you know, overall speaking, if we talk about for the business asset disposal, there are 2 points that you need to consider over here. Number one, the ownership, the ownership for the shares have to be at least for 24 months over here, right? So if I look over here for the minor limited, these shares, this is the minor limited, right? Unquoted company with an issued share capital of 200,000. Zola has been director of the company since 1st April 2018, and she had originally purchased the shares on 15th August 2022. So she bought the shares on 15th August and then she sold her shares on 20th June 2024. So 15th August to 15th August 2023, then 15th August 2024 would have been the complete 2 years, right? So minor company, if I look, holding period is less than 24 months over here. Number one. And then for major PLC, right? The 2 million is issued and she just had 16,000 over here. So 16 by 2 million. That's just 8%, around about like 0.08 rather, not 8 even. So that is 0.8% over here. So you need to have a holding. This is not more than 5%. So that's just 0.8% over here. So technically speaking, if I talk about the minor PLC or the minor limited, this is the holding period issue over here. Then for the major PLC, this is the size of the shareholding over here, right? So that is why Zoila has not been able to claim for the business asset disposal relief over here, right? Then point number two, it asks that what cost figure will have been used in calculating the chargeable gain on Zoila's disposal of 20,000 shares in minor limited over here. So we have to calculate the cost in the Zoila Limited. Okay. Now, if I go over here, I have the number of shares and then I have the amount as well. Now, if I go, she had originally purchased on 15th August 22,500 for 117. 15th August 2022. Yeah. 22,500 shares and they were bought for 117,000. And then on 12 December 2022, there has been a right issue of 1 for 1 share at 7.4. So we can have okay. So we had a right issue over here for 1 for 1 share. So technically we got into 22,500 shares. So 22,500 into 7.4 over here. So that's going to be 166,500 over here, right? So the total shares that we got, they would have been for 45,000 total shares, and the amount, total amount would have been 283 over here, right? So if it's 283, now I have sold the shares 20th June for 20,000. So 20th June, that's going to be 24, sale of 20,000 shares. So technically speaking, 283,500 is the value of 45,000 shares multiplied by 20,000 shares. I get 126,000 over here. So this 126,000 is going to be my base cost over here, right? Okay. Point number three. What proceeds figure will have been used in calculating the chargeable gain on the Zoila disposal of 16,000 shares in Major PLC? Okay, now this has been sold to 152,000. Now I have to go for the proceeds which have to be used in calculating the chargeable gains over here. So we will have to see at the average price per share. 9.6 to 9.74. So that's gonna be 9.62 plus 9.74 divided by 2, right? So the average price is going to be 9.62, 9.74 by 2. That's going to be 9.68 over here, right? And then the total value of the shares would have been, I have sold 16,000 shares into 9.68, 154,880. So this 154,880 is going to be the cost over here, right? Okay. Okay, now the point number 4 is if Zoila had delayed the sale of her 16,000 shares in Major PLC until the 6th April 2025, by how long would the related CGT liability have been deferred? So if she would have deferred for the, you know, till 6th April 2025, then technically she has gone to the next year. She has basically taken her disposal to the next year, because currently we are into the 24-25 now. We are currently into the 24-25. So technically, if she goes to the 6th April 2025, then she goes into the next tax year. And she goes into the next tax year, then the date of the payment would have gone to 31st January 2026 over here. So exactly by 12 months, right? So I'll go for the 12 months over here, because exactly by 12 months she would have had deferred the amount for the payment over here. And then, which of the following statements about how much CGT Zoila would have saved if she had delayed the sale of her 16,000 ordinary shares in Major PLC until the following year are true over here, right? So assume the tax rates that we have and allowances for the year of 24-25 are going to apply over here. Zola would not have saved any CGD but would have benefited from the delayed of as far as the payment is concerned. Now, talking about as far as the saving on CGT is concerned, this would have been currently, if we see, Zoila has sold the shares in the minor, then she has sold the shares in the major one. It's asking about the major, yeah, therefore. So we had this is 16,000 into 9.68 over here. So the amount of the disposal proceeds, so that's gonna be 16,000 over here. Okay. So now if I go into the minor, the annual exempt amounts are over here. Okay. So now if I look, this is just the capital gain tax. This is just 10,600 over here. And this is basically the remaining amount for the basic band rate that I have over here. Right. So if I would have had deferred this up, right? If I would have deferred this up, then technically speaking, this 10,600 into 20 minus 10 is going to be the 10% over here. So this 1060 would have been saved, right? This would have been saved in the basic band rate over here, right? I would have had carried it forward, if I would have had carried it forward, then this 10,600 would have been saved over here, right? So this is the tax saving that I can, bring down over here, because this is something I would have paid. So saying that Zola would not have saved any tax, this is false over here. And then if I go, Zola would have saved 3,000 into 20% due to the annual exempt amount for the tax year 25-26 being available. So this statement is true over here. And then Zola would have saved 10,600 into the 10%. So I got this 10% over here of the 1060 over here due to the remaining. It's saying about the remaining. No, it's not on the 20%. It's going to be on the 10% over here. The saving is going to be on the 10%, not on the 20%. This is wrong, because technically speaking, the remaining basic band is something that would have been available, and that would have been, saved over here, not the 20%. Basic 10% is what we are going to have over here, right? Okay, so this is what we have over here. Moving ahead from here, now we have this question number 3 over here, and this is the Holly and Goma. Okay. Now, you should assume that the tax allowances for the tax year 24-25 are applied in the previous tax years. Holly and Goma are a married couple. Capital losses brought forward. Holly had capital losses of 39,300 for the tax year 22-23. He had chargeable gains of 7,000 for the tax year 23-24 over here. Goma had capital losses of 9,100 and chargeable gains of 6,900 for the tax year 23-24. She did not have any capital losses for the tax year 22-23 over here. Okay. Now we have these capital losses over here. Then we have these ordinary shares in Lima Limited. On 24th July, Holly sold 5,000 $1 ordinary shares in Lima for 4.95 per share. Lima Limited shares have recently been selling for 5.30, but Holly sold them at the lower price because he needed a quick sale. Goma, Holly's wife, had originally subscribed for 30,000 shares in Lima at the par value of 1, and then on 28th July 2012, then on 18th August, she gave 8,000 ordinary shares to Holly. So on this date, the market value of 8,000 shares was 23,200. Holly and Goma will both dispose of their remaining shareholders in Lima during the tax year 25-26. However, they are unsure as to whether these disposals will qualify for the business asset disposal relief or not. Then we have this in T table, and then we have this disposal by Goma during the year. So I have the next point, that is what amount of unused capital losses do Holly and Goma have brought forward to the tax year 24-25 over here. Okay, so we have to see about Holly and Goma, that what amount of unused capital losses do we have. So we have this Holly, this is Goma. I have the chargeable gains over here. He had chargeable gains of 7,000 for the tax year, right? So this is going to be chargeable gain less annual exempt amount. That's 3,000. So I get a balance of 4,000 less capital losses brought forward. So we are just going to have the 4,000 of the losses brought forward. So my taxable gains are going to be 0 over here, right? And then if I look amount of unused losses, so the total losses brought forward I have are Goma had, not Goma, Hali. I did happen to read this. Hali had capital losses of 39,300. 39,300 less claimed 4,000. So losses carry forward are going to be 35,300 over here. Then for the Goma, I had capital losses of 9,100 and chargeable gains are 6,900 over here. So 6,900 are over here. Current year capital loss. So she did not have any capital losses for the tax year over here, right? So in the current year, she has a capital loss of 9,100 now. Let me write it over here. This is going to be my chargeable gain 6,900 less current year capital loss. I am going to minus this 6,900 over here because Goma has the loss in the current year as well. So this loss has to be adjusted against this income over here, right? So the net gain is going to be 0 over here. And then if I look at my total capital losses, then for the, she did not have the previous year losses over here, right? So total loss for the year is 9,100. Out of this, the utilized amount is 6,900. So loss carry forward is going to be 2,200 over here, right? So 35,300, 35,300 and 2,200. Option D, this one. No, sorry, this one. 35,300 for Holly, and then for Goma, that is going to be 2,200. Straight calculations. Okay, now what cost figure and what value per share the disposal value will be used in calculating the chargeable gain on Harley's sale of 5,000 shares in Lima Limited over here. If I go in the top, the Lima Limited, okay, Lima Limited, Lima Limited, okay. So we are, these were £1 ordinary share. Okay. They had subscribed for the share at their par value. So they subscribed for the shares at their par value, right? So these were 5,000 shares multiplied by par value So that's gonna be 5,000 over here, right? So the cost is gonna be on this, and then they have sold the share for 4.95. This one. The shares have been sold for 4.95. So the cost figure is going to be 5,000 and the value or the par value is going to be 4.95 over here, right? Okay. Then in deciding whether Hali and Goma's future disposal of their shareholding in Lehman Limited will qualify for the business asset disposal, which one of the following statement is correct over here? Okay, now in deciding whether they are going to have a relief or not. Now, basically, for having this, the business asset disposal relief for this budget, basically, that we say. Uh, if you explicitly check it onto the shares, right? Then the point is you have to see either the seller is the employee of the company, right? Or you have a 5% holding of the company. Either you are the employee of the company, you're working in the company, or you have the 5% of the shares of the company, right? So if this is the case, I mean, if you have been employed for the company for 2 years, or you have been holding the 5% of the shares for 2 years, then in that case, you are going to be, the one who is going to be entitled for the business asset disposal relief over here, right? So saying that Hali and Goma must be the directors of the Lima Limited, no, this statement is wrong. Lima Limited must be a trading company. Yes, it should be a trading company. So this statement is true. Then Harley and Goma must have shareholding of 10%, not 10%. That's going to be 5%, right? And the qualifying condition must be for the 3 years, not 3 years. These are to be for 2 years. So only statement two is correct, that the Lima Limited must be a trading company, because in Holly and Goma, they are to be working for the company. They can be the employee of the company, not necessarily the directors. Then the percentage is 5%, not the 10%, and the qualifying period is basically 2 years, not the 3 years over here. Okay, so what is the base cost of the Harley's replacement antique table? Base cost for the antique table over here. On 11th October 2024, an antique table owned by the Harley was destroyed in fire. The table had been purchased on 3rd June 2014 for £44,000. Harley received insurance proceeds of 62,000 on 6 January. Then he purchased a replacement tea table for 63,600, and Harley will claim a rollover, the gain arising from the receipt of the insurance proceeds over here. So the point is he just got the receipts of 62,000, whereas the base cost of the table was 44,000. So the insurance proceeds 62,000 less the base cost, which is 44,000. So the chargeable gain is 18,000. Okay. So we are going to have this at 18,000 over here. Now, the cost of replacement table, this one. The replacement table has been 63,600 less the gain deferred. So the base cost 45 600. All right. Okay. Then how many of the five assets disposed of by Goma during the tax year are exempt assets for the purpose of capital gain tax? Five assets. Now, how many five assets we have? Disposals of Goma. Okay, these five assets. Qualifying corporate bonds. Qualifying corporate bonds sold for 38,300. These are going to be exempt. Then the cars are basically exempt from the CGT as well. And then the antique vase, the vase is going to be taxable. Copyright, taxable, quoted shares. So three, I can say. Three investments of the three shares are something that we can have over here, which are going to be exempt over here, you know, related to as far as the exempt asset disposal is concerned, right? Okay. Now, let's just have a break of 5-7 minutes or so. We're gonna come back and then we're gonna resume. Okay, I'm back. So let's resume now. We have this Jerome question now. And the Jerome question is Jerome made the following gifts to the family members in the tax year 24-25. 1, 2, 3, 4. Now, we have these points over here 1, 2, 3, 4, 5. Number one. What is the chargeable gain, if any, arising on the gift of the house? On 28th May 2024, Jerome made a gift of a house valued at 187,000 to his wife. Jerome's uncle had originally purchased the house on 14th July 2003 for 45,900. The uncle died on 12th June 2012 and the house was inherited by the Jerome. On that date, the house valued at 112,800. Jerome has never occupied the house as his main residence over here. Now, this is where the house has been gifted to the spouse over here, right? So the disposal of assets between the married couples and the civil partners are automatically on a no gain, no loss basis, right? So if you even if you are provided with a market value or the proceeds, right? So they are over there just to divert you from the basic understanding or the core understanding, right? So the gift of the house is not going to rise any gain or loss because it's a transfer between the spouses, right? So the amount is going to be zero over here. Now, second one, what amount of the gift holdover relief, if any, is available on the gift of the shares in the reward period limited on 24th June over here? Now, on 24th June, Jerome made a gift of his entire 12% holding of 12,000 ordinary shares in Reward, an unquoted trading company, to his son. The market value of the shares on this date was 98,400. The shares have been purchased on 15th March 2014, 10 years ago almost, okay, for 39,000. And then on 24th June 2024, the market value of the shares was 540,000, of which 460,000 was in respect of the chargeable business assets. Jerome and his sons have elected to hold over the gain on this relief, on this gift of a business asset over here. Now, as far as this you know share gifting is concerned, now this gift holdover relief is going to be the restriction of the gift holdover relief that applies to the specific scenario given over here, right? Now, when an individual makes a gift of the shares in their personal company where the ownership is for more than 5%, the gift holdover relief is restricted by the reference to the proportion of the company's chargeable business assets to its chargeable assets over here, right? So if I look over here, the amount that I have is the market value of the share is 98,400, whereas they were purchased for 39,000 over here, right? So market value of shares 98,400 less their cost, which is 39,000. So we get this 59,400 over here, right? So the overall gain is 59,400 over here. So this 59,400 is going to be multiplied by 460 and then this is 540. So the total value of the chargeable assets is 540 and the value for this is going to be 460 over here. So we are simply going to get to divide by this. So we get 59,400 into 460 by 540. So 50,600 is the amount that we get over here. Okay. So we'll have this one and we'll have this one over here. Okay. Then, what is a chargeable gain, if any, is arising on the gift of the antique bracelet? On 7th November, Jerome made a gift of an antique bracelet valued at 12,000 to 12,200 to his granddaughter. The antique bracelet had been purchased on 1st September for 2,100. So, value of bracelet 12,200 less cost 2,100. So my chargeable gain is 10,100. Right? Okay. So that's gonna be 10,100. So this is has to be compared. The maximum gain which can be recorded is 12,200 minus the deemed cost into 5 by 3. So that's going to be 12,200 minus 6,000 into 5 by 3. Yes, this is lower, 10,100. So we'll have this one over here. All right, we just compare it with the deemed maximum which we can record. So it's lower than this amount. So we will have 10,333 over here. Then, what cost figure will be used in calculating the chargeable gain on the Jerome's gift of 9 hectares of land on 29th January over here? 9 hectares of land on 29th January. Okay. On 29 January, Jerome made a gift of 9 hectares of land valued at 78,400 to his brother. He had originally purchased the 10 hectares of the land on 3rd November for 37,800. The market value of the unsold hectare of land at 29th January was 33,600. The land has never been used for the business purpose. So if I go over here for the calculation, the cost of 9 hectares of land gifted is, we have 10 hectares at 37,800, right? And we have gifted the value at 78,400. So market value of 9 hectares of land is 78,400. Then market value of 1 hectare of land is 33,600. Unsold hectare land, yeah, 33,600. Total value of 10 hectares of land is now 112,000, right? Now, from this, you have chargeable gain, no? So this is going to be straight one, the part disposal is going to be A over A plus B. Now that is what we have to do over here. So that is This is going to be 78,400 divided by 112,000. So 78,400 by 112,123, that is going to be the percentage over here, right? Exactly 70%, which we have sold. Yeah, so chargeable gain is what we have to calculate now. So the chargeable gain is going to be, this is the 78,400 over here, right? No, this was the formula. I just slipped the formula over here. Wait a second, let me see if it's somewhere in the tax table. No. The formula was the formula which we used to do was A over A plus B. This is what I remember. Right? So the part disposal, it basically needs to have, like, A over A plus B to the full cost of the land is what we do it over here, right? So if we do this A over A plus B into cost of land, this is what we basically do, because we have to find the cost figure over here, right? So the amount that has been gifted is 78,400. Amount, the original cost of the land was 37,800 over here. So 37,800. Yeah, this is the 37,800. So if I take 37,800 into 70%, because yeah, this is 78,400 by this one now. So this should be the answer over here. This is the original cost of land multiplied by total value of land. Yes. Original cost is 37,800 multiplied by 78,400, the value of 9 hectares, divided by 112,000, the value of 10 hectares over here, the market value, right? So you get 26,460 over here. This is going to be your correct answer. Yes, this one. Then for each of the following statements, let whether it's true or false in relation to the gift holdover relief over here. The company must be an unquoted note. The company has to be the quoted one. We have talked about it. The company must not own any non-business assets. This is false, but the company can own the non-business assets as well. The company must be a trading company, yes. And the Jerome must have owned the shares for at least 2 years. Jerome. Why? I mean, why is it necessary for the Jerome? Because there's no, like, requirement for, as far as the ownership is concerned, for the gift holdover relief is concerned. We don't have to have any, like, requirement for the gift holdover relief. So this statement is gonna be false over here, right? Okay. Then moving ahead from here, let's see now, what do we have? Okay, now we are going to have this Ginger question over here, Ginger and Nigel. You should assume that today's date is 1st March 2025. The scenario relates to one requirement only. Okay. And that is Ginger has a holding of 10,000 £1 ordinary shares in Nutback Limited, an unquoted trading company, which she had purchased on 13th February 2014 for 2.9 per share. The current value of the shares, as agreed with the HMRC, is 6.4 per share, but Ginger intends to sell some of the holdings to her daughter at 4 per share during March. Ginger and daughter will elect to hold over any gains as gift of a business asset over here. For the tax year 24-25, Ginger will not make any other disposals and has therefore not utilized her annual exempt amount over here. Okay. Now, the requirement is explained how many £1 ordinary shares in Network Limited Ginger can sell to her daughter for 4 per share during March 2025 without incurring any capital gain tax liability for the 24-25 over here, right? Your answer should be supported by the appropriate calculations over here. Now, remember this thing where there is a disposal at undervalue, right? I mean, you are not straight away giving it as a gift or something, but you are disposing it at an undervalue or something. Then the part of the gain, it can be chargeable now and it cannot be, held over or it cannot be deferred, right? Because if you are charging something, if you're getting something, although it's a minimum amount or minimal amount, you will have to calculate the gain for that amount over there, right? So overall speaking, Ginger has not utilized any annual exempt amount over here, so we can straight away calculate up to the amount that annual exempt amount is not utilized or not, right? So we can say for this part that the disposal of shares is at an undervalue. So the gift element of the gain can be held over, right? And then the chargeable amount will be £4. Someone holding at £4. This is over here, right? Minus the purchase cost is 2.39. So 4 minus 2.39 per share. So the chargeable amount is going to be 4 minus 2.39 per share. Then Ginger's annual exempt amount is £3,000. So the number of shares which can be sold safely without triggering the capital gain tax is that is going to be this £3,000 divided by this amount, 4 minus 2.1.61. That's gonna be 1.1863 shares. So 1863 shares. So therefore she can sell as far as the 1863 shares are concerned because they are not going to attract any, like, as far as the capital gain tax is concerned. Because overall, if I show you the movement, the market value of the shares over here is 1863 shares multiplied by 6.40. So that's gonna be 11923 less cost of shares is 1863 into I got the share for 2.39. 63 into 2.39 is 4453. So my capital gain over here is going to be 7471, right? Now, the gift holdover relief, which I can do over here, is the 1863 multiplied by the market value is 6.4, whereas I am, giving them for 4. So this is the amount which I'm not charging. So for this, I can do the gift holdover, right? So that is going to be 1863 multiplied by 6.4 minus 4. That's going to be 4471, right? So my chargeable gain is going to be, look, other way around, 2999, right? And my annual exempt amount is 3000. So my taxable gain over here is going to be 0, right? Okay. Now I hope it's clear. Moving ahead. This scenario relates to one requirement. Innocent and Nigel, a married couple, both have shareholdings in Cinnamon Limited, an unquoted trading company with a share capital of 100,000 £1 ordinary shares. Innocent has been the managing director of Cinnamon Limited since the company's incorporation on 1st July 2014, and she currently holds 20,000 shares with matching voting rights in the company. These shares were subscribed for on 1st July 2014 at their par value. Nigel has never been an employee of the directors of the Cinnamon Limited, and he currently holds 3,000 shares with matching voting rights in the company. These shares were purchased from an existing shareholder on 23rd April for 46,200. Either Innocent or Nigel will sell 2,000 of their shares in Cinnamon Limited during the March for 65,000, but they are not sure which of them should make the disposal. For the tax year 24-25, both Innocent and Nigel have already made disposals which will fully utilize their annual exempt amounts, and they will each have taxable income of 80,000 as well. So they will have a taxable income of 80,000. Okay. Now the requirement is calculate the capital gain tax saving if the disposal of 2,000 shares in Cinnamon Limited during March is made by Innocent rather than Nigel. Okay. So if part B, if Nigel rather than Nigel, so we are doing by the Innocent. If Innocent makes a disposal rather than Nigel. So we have disposal proceeds. They will do it for 65,000. Then we have less the cost. We are planning to sell 2,000 shares. They were subscribed at their par value of $1. So we have a chargeable gain of 63,000. right? All right. Now, as far as the capital gain tax is concerned, that's gonna be 63,000 into 10%. So that's gonna be 6,300, right? So this is something which we are going to have over here, and this is the innocent has been the managing director of the cinema. No? So basically, this is going to be qualified for the budget as well, right? Business asset disposal, right? And now, if we go and talk about, for the sake of the practice, that if Nigel makes the disposal, right, then you have disposal proceeds of 65,000 less cost. Nigel has never been employed and he currently holds 3,000 shares with matching voting rights. So he has 3,000 shares over here. So these shares were purchased from an existing shareholders for 46,300. Now, if he makes a sale of the 2,000 shares, so these were purchased for 46,200. Total value divided by 3,000. Now he's planning to sell 2,000 shares by 3,000 into 2,000. We get 30,800. So the chargeable gain is going to be 34,200. Now, the capital gain, that is 34,200 into 20%. That is going to be 6,840. Because he's a higher taxpayer, now because of the 80,000 amount over here. He's a higher taxpayer, so 20% is what we are going to have over here, right? So this is what we are going to have. So technically speaking, if we say that who should make the sale and all, na? So technically on this point, the sale should be made by the innocent because by this they will have to pay a tax of 6,300. By this they will have to pay a 6,800 tax. So technically they can have a saving over here. So we have a saving of 6,840, 6,300, and that's going to be 540 over here, right? So we will have a saving of 540 over here. Okay, I hope it's clear. Now, within 2 minutes, we are starting the next question. Okay. Now, the next question that we have is the Daljit question over here. This scenario is related to two requirements. Please assume that today's date is 5th April 2024. Diljit wishes to sell personal assets to generate funds to pay his daughter's university's fee, and he has selected two assets that he is willing to sell. He will sell one of the assets to a third party on 31st December 2024 and will make his decision based on the asset that will generate the highest amount of the net proceeds. The assets of the lead has identified as potential disposals and are as follows. 1,000 shares in ABC Limited. Daljit acquired 1,000 shares in ABC Limited Trading Company on 7th June 2019 for 6,000 when he became an employee of the company. On 7th June 2020, ABC Limited underwent a rights issue, offering the shareholder the opportunity to purchase two shares for every five already held at £50 per share. Daljit purchased the maximum amount of the shares. ABC Limited has 20,000 shares in issue. If Diljit sells the shares, he will sell 1,000 shares worth 100,600 on 31st December 2024 over here. Holiday Cottage. The cottage is currently worth 110,000 and legal fee in respect of the disposal are expected to be 1,000. Repair costing 3,500 were made to the cottage roof in December 2022 following the damage caused by the storm. Diljit originally bought the cottage in May at a cost of 64,700. It has always been let out, and Diljit has never occupied the property as his private residence. Other information is Diljit will be a higher taxpayer and will make no other disposals in the tax year 24-25. The requirement is simple that you have to calculate which of the above asset disposal will result in the highest amount of proceeds after deducting the tax and any cost of sale over here. Okay, just 1 second. Okay. So we now have to evaluate that which should we go with. So I have the shares in ABC Limited. I have a holiday cottage as well. Now I have the disposal proceeds. He will sell 1,000 shares worth 100 and 600, right? Less selling costs. I won't be having any selling cost over here because these are straightforward. And then I am going to have the capital gain tax over here. So I will go into the workings. I will have the CGT on sale of shares. Now, if I go on the sale of shares, I have the disposal proceeds of 100, 600 over here. And then I have my cost over here. As far as the cost is concerned, I have set one purchased. I got 1,000 shares for 60,000. Then I got my right issue of shares And the right issue was 2 for 5 shares at £50 per share. So 2 for 5 shares at £50 per share. So that's 20,000. And 2 for 5 shares means 400 shares. So I have total shares 1400 with a value of 80,000. Now the disposal of 1000 shares will have a cost of 80,000 by 1400 into 1000 is 57143 over here, right? So 57,143 is going to be my cost. 57,143 is going to be my cost over here. So my chargeable gain is going to be 43,457 over here. Less annual exempt amount is 3,000. So my taxable gain is going to be 40,457 over here. So my capital gain tax is going to be 40,457 into 10%, 4046, right? So my gain over here is going to be 4046, right? So my net proceeds are going to be 104646 over here. All right, these are going to be my net proceeds over here. Now, as far as the holiday cottage is concerned, it's currently worth at 110,000, so it will be sold for 110,000, right? And its disposal and the legal fee in respect of the disposal is expected to be 1,000. And then the capital gain, working one. CGT on disposal of cottage. I have my disposal proceeds, and these are 110,000. Selling cost 1,000. Net disposal proceeds are going to be 109,000. And then I am going to less my actual cost. I got it for 64,700, right? So I will have my net amount over here. Net amount is going to be 44,300. That's the annual exempt amount, 3,000. Taxable gain, not total gain, taxable gain. 41,300 over here. Then capital gain tax, 41,300 into Diljit is a higher tax payer, and this is the disposal of the holiday cottage. So if this is a disposal of a holiday cottage, the higher tax rate on the residential property is at 24%, right? According to the table that we have. So that's going to be taxed at 24%. So this is going to be 41,300 into 24 is 9912, right? So 9912. I was supposed to minus this out. So I will have my net amount of 99,088, right? So we can say that Daljit should sell the holiday cottage and this will generate the higher net proceeds, right? So this is what we have done over here. Okay, now briefly explain why the disposal of either the ABC share or the other one is not going to have any impact whatsoever related to holiday cottage and not subject to the inheritance tax over here. Uh, Inheritance tax, I mean, if we talk about this is something which is transferred or which is charged on the value that is transferred of the chargeable property by a chargeable person, right? I mean, if you remember, as far as the definition was concerned, that the inheritance tax is charged on a transfer value of a chargeable property by a chargeable person, right? So, our transfer value of the gift is a gift of any asset which results in the reduction in value of the donor's estate. Now, the dealer is basically going to sell the shares or the holiday cottage at an arm's length transaction and receive the consideration in return. He does not intend to make a gift of the either assets, so there is no transfer value of the inheritance tax, right? So there's not going to be any inheritance tax whatsoever on that. That because he's not, giving it, but rather selling it to the third party. That okay. Now we have this Kate Limited. Now let's just talk about from the company's point of view. So we are going to have this question now. Kitten is the controlling shareholder in the CAT Limited, an unquoted trading company. CAT sold a freehold factory on 30th November 2024 for 394,000, which resulted in a chargeable gain of 131,530 in the company's year end of 31st March 2025 after the deduction of the indexation and the professional fee. The factory was purchased on 1st October 2005 for 138,600 and the capital improvements were made at a cost of 23,400 during December 2007. The relevant indexation factors are from October 2005 to December 17 of 0.439, then from December to 2007 to December 2017 of 0.319. Okay. Kate Limited is unsure how to reinvest the proceeds from the sale of the factory. The company is considering either purchasing a freehold warehouse for 302,000 or acquiring a leasehold office building on a 40-year lease for a premium of 370,000. So if either of the investments is made, it will take place on 30th September 2025. All of the above buildings have been or will be used for the purposes of Kate Limited's trade. Okay. So even if we get the warehouse or we get a leasehold office building, they are going to be used for the trade purposes over here. Now, this is what for the Kate Limited is. Then for the Kitten sold 20,000 ordinary shares in Kate on 1st October, which resulted in a chargeable gain of 142. The disposal qualified for the business asset disposal relief. Kitten had originally subscribed for the 90,000 shares on 7th July. Then, on the 22nd September, Kate made a 243 right issue. Kitten took up the allocation in full, paying 6.4 for the each new share. Then Kitten also sold an antique vase on the 16th January, which resulted in the chargeable gains. And Kitten had the taxable income of 12,000. Now, what amount of indexation allowance will have been deducted in calculating the chargeable gain of 133,530 on the disposal of Kate Limited's factory over here? Okay. So amount of indexation allowance is something that we have to calculate. So technically speaking, I can simply see that as far as the cost is concerned, cost, this the factory was purchased on 1st October for 138,600. Then we had some capital improvements at a cost of 23,400. 23,400. So total is going to be 162,000. Right now, as far as the indexation is concerned, I had from 1st October 2005 to December 17. To December 17, I had this 0.439 multiplied by the cost 138,600. I get 60,845, and then I had for indexation from December 2007 to December 2017 of 0.319 into the cost for the repairs, and that is 23,400. 7,465. Total amount is going to be 68,310 over here. So 68,310 is going to be the answer over here. Now, if Kate Limited decides to purchase the freehold warehouse and makes a claim to roll over the chargeable gain on the factory under the rollover relief rules, which of the following statements are true? The base cost of the warehouse for chargeable gain purposes will be 174.70. We'll have to calculate the base cost of the warehouse. The base cost of warehouse. The cost of the warehouse is going to be 302,000. Gain roll over is going to go into the workings. So the gain is going to be Chargeable gain is 131,530. All right. Then we have the chargeable gain, right? That is proceeds not invested. So we got the proceeds are going to be 394 and it's going to be bought for 302. So 394 minus 302. That's 92,000 over here, right? So gain not invested is basically 92,000. This is the total gain. This is not invested. So the rollover is going to be the balancing, which I can claim over here. So that is going to be 39,530 over here. So the gain rollover is 39,530. So I have my base cost over here. That is 262,470 over here. So this is the base cost of the warehouse. So it's saying the base cost of the warehouse. This is wrong. This statement is false. Now, the claim for the rollover relief against the warehouse must be made by 31st March over here. It's not gonna go by this. The gain is the claim normally that we do. That is for the 4 years period, right? So the 4 year period after the year end in which it has been sold, this is what we have to do over here. So the sale has been made over here. On 30th November 2024, I will be selling it up, right? So it will be sold on 30th November 2024. And if it's going to be sold by 30th November 2024, so the year end is technically going to be 31st March 2025, right? So if it's 31st March 2025, I can take it 4 years forward, 26, 27, 28, 29, and then 30, because it's going to be replaced in the next year. In 2025, I sold, it's going to be replaced in 2026, then 4 years after is 2030. So saying that the claim is going to be available in 31st March 2029 is wrong because it's been replaced in 2026. So 4 years plus, that's going to be 2030 over here. A further claim for the rollover relief may be made if another qualifying asset is acquired at 31st March 2028. Now, the further claim for the rollover relief which can be made, I mean, if another asset is acquired by not 31st March, that is after 3 years, right? So 3 years are going to end on, it has been sold on 30th November now, 2024. So 25, 26, 27. It has to be 27 November over here, not March. So this statement is wrong as well, right? So all three statements, they are going to be wrong over here. Done? And then if Kate Limited decides to acquire the leasehold office building and makes a claim to hold over the chargeable gains on the factory under the rollover relief rules, what is the latest date by which the held over gain will crystallize? Held over gain crystallize. For this point, the gain is going to crystallize normally on the earliest of when the asset is being replaced or the asset replacement is disposed of as well, or the date of the asset replacement ceases to be used for the trade purposes, or 10 years from the date of the replacement of the assets acquisition, basically, right? So the latest date that we can have is basically the 10 years, right? Because if we are getting a leasehold building over here, the building, wait a second. Building. Where's the building now? Yeah, now if we look over here, freehold warehouse or a 40-year office building. Yeah, 40-year office buildings over here. So we are going to have this 40-year life over here. So technically, this is the 10 years that we have at the latest date over here, right? Because the life of the 40 years is way too far. So we will have to wait for the 40 years till we cease to use the asset for the trade purposes now. So that's going to be the 40 years wait. So the latest date that we can have is the 10 years. So if it's the 10 years over here, so the 10 years from the 30th November or the 10 years from the 30th September. No, it's going to be from the 30th September 2025. So it's going to be option D over here, right? And then it asking that what cost figure will have been used in calculating the chargeable gain on the kitten's disposal of 20,000 shares. So cost figure is what you have to find for the 20,000 shares that we have disposed of. Now, this is simple that we have already done in the previous questions as well. So I'm just going to follow that lead. And that is you are going to have the number of shares and then you will have their respective cost as well. First chunk bought. You bought the first chunk, 90,000 shares on the par value. And the par value was $1. Sorry, £1. That's going to be over here. Then we had a right issue over here. Right issue was 2 for 3 shares and 6.4. 6.4. 60,000 shares at 6.40 per share. So that's going to be 384,000. So you had 150,000 shares, which had a total cost of 474,000. Right? Now, you have disposed of 20,000 shares. These are 150,000 shares, 20,000 shares. 63,200. So the cost of the shares is going to be 63,200 over here, right? Then, what is Kitten's capital gain tax liability for the tax year 24-25 and by when it must be paid? Now, we have to calculate for the Kitten over here. This is the Kitten. This is a sale of antique watch, and this is the sale of shares. So we have two things over here. As far as the shares are concerned, they are the ones having the border. So we have the shares and then we have the watch. Now, as far as the shares are concerned, we had 142 200 chargeable gain. Whereas for the was chargeable gain of 26 100. Right? Now, as far as the AEA is concerned, that's going to be 3,000 over here. So my taxable gains they are going to be 142,000. This is 23 100. Now we are going to have the chargeable gains tax. On this, we are going to have a 10%. On this, we are going to have the 20%. Right? And this one is 142 into 10, 23 100 into 20. So we will have total CGT 18,820. Oh. This is 142 200. So 14 to 20 now 18,840. Yeah, set. So we are going to have this 18,840. And now when it should be paid? It should be paid 6 months after. So no, not 6 months after. It was sold in November now, so it's gonna be on 31st January. Yeah, this one. Yep, they are gonna be on the next one, right? Okay, so we have this answer over here. Done. In 2 minutes, we are starting the next question. Let me open up the next question. Meanwhile, you can start reading it, and we are gonna start it in just 2 minutes. Okay, let's start with this Fogo Limited now. Fogo Limited has 100% subsidiary Nita Limited. Now, Fogo Limited, during the year ended 30th September 2024, Fogo Limited made the following capital disposals on 31st October. Fogo Limited sold an investment property which had been let out to tenants since it was acquired. The investment property was sold to an unconnected company for 625,000. It had cost 500,000 when it was acquired in February 2010. Then on 4th May 2024, Fogo Limited had sold a freehold warehouse which had used exclusively in its trade. The warehouse was sold to an unconnected company for 560,000. It had cost Fogo Limited 100,000, which was acquired in September 2001. On 19th September, Fogo Limited sold 4% shareholding in unconnected trading company, resulting in a capital loss of 25,000. Indexation factors are 0.593 and 0.269. Then we have the NITA Limited and the interest payable, interest receivable. And the first requirement is, what is the chargeable gain or allowable loss on the disposal of the investment property on 31st October by the Fogo Limited? Investment property, this one. If I go, I have sale proceeds 65,000, right? And then I have the cost. Uh, sorry, this is 625,000. Sorry, my bad. 500,000. So I have a gain of 125,000. Now, indexation allowance that I'm gonna have over here is 500,000 into the first one, and Fogo Limited, which had been lent out, and this is going to be, it was acquired in February 2010. So this one, 2.26 now, this is the indexation allowance that I have to lose. So that's gonna be 0.269. So the allowance which I'm gonna have, oh, I will have this at 134,500, higher than the gain over here now. So mine indexation cannot create a loss. So technically speaking, this is going to be a 0 over here. So the gain which I'm going to have is 0 because my indexation allowance is on the higher side. So £0 is going to be the answer, right? So now we have the disposal of the warehouse over here. Now for the disposal of the warehouse, this warehouse is sold for 560,000. Cost is 100,000 over here. So the gain is 460,000. Indexation allowance, I am going to have for the cost. Now the warehouse was acquired September 21, so 0.593. I have this at 59,300. This is the gain over here. So the gain to be recognized is going to be 400, 700 over here as the answer. So 400, 700 is going to be option D over here. Okay, slide 2, which of the following statements are the requirements for the Fogo Limited and the NITA Limited to claim the group over relief? NITA Limited. For year ended, Nita Limited has a draft tax adjusted trading profit of 180. This has been calculated correctly, but does not include the interest payable or receivable over here. Okay, so Nita Limited asset acquisition took place within 1 year and before and 4 years after the disposal, which is a qualifying condition for a group rollover relief. Asset acquisition took place 1 year before. Uh, as far as the asset acquisition is concerned, rather than going for the first year or something, it is the 3 years before, sorry, not before 1 year, that is after the 3 years after the disposal that we have to have over here. And obviously, a 75% of the group relationship is required as well. I mean, if you want to claim for the group relief, you need to have the 75% holding of the company as well, right? So, technically speaking, saying 4 years after, this is wrong. This is wrong. So you need to have the 3 years limited limit over here. Then the freehold warehouse sold by the Fogo on the 4th May is a qualifying asset and was used in Fogo Limited trade. True, because this was used. Then the shares acquired by Neta in the Jona Limited are qualifying business assets for the rollover. Okay, it acquired the shares in Joanna. We don't have any information about the Joanna. This. Interest. This is the 3%. We just have a 3% holding over here. So 3% holding doesn't give us the the qualifying business over here, right? Because this is not gonna be overall that we can have over here, right? So this statement is wrong over here. Nita has a 75% of the Fogo Limited. Yes, this is true over here, right? Nita is going to be the 75% holding, because if I look over here about this Nita, this is the 100% subsidiary. So technically, yes, the 75% point is met over here as well, right? So B and D are going to be the correct answers over here. Then, assuming Fogo Limited gain is rolled over into the purchase of the fixed plant and machinery by the Nita Limited, select which of the following events will not result in gain become chargeable. Which of the following will not result in the gain? Nita Limited selling, no, if you sell the plant and machinery, you will have to pay the gain. Fogo Limited selling the shareholding Nita. If Fogo Limited straight away sells the Nita and then Nita do whatever she wants to do, the Nita Limited, I mean, the Fogo Limited is not going to be responsible for that, right? So the correct answer is going to be the B over here, right? Then point number 5 is, what is Nita Limited's total non-trade loan relationship income? Non-trade loan relationship income. We have interest payable and interest receivable over here. We have the interest receivable of 35,000. This is going to be 35,000, and then loan interest payable. We have a 1 million loan, which is at 5%. Interest is payable of 50,000 was in respect of the following. Number one, interest on 550,000 on the loan required to of the loan to acquire the fixed plant and machinery. The fixed plant and machinery has an expected useful life of 15 years, and then interest of for 50,000 of the loan to acquire a 3% holding over here. Now this for 50,000 over here, the interest on loan, this is gonna be accounted for over here as a non-trade, because the loan which we have taken to acquire the plant and machinery, this is something which is going to be related to the trade over here. right? The interest on loan to acquire the plant machinery that you have over here is going to be trade related, right? So it's gonna not come over here, right? And the interest on the loan to acquire the shareholding is for not trading purposes, which is going to be, shown over here, right? So we have this 450,000, and with this, we are going to have the interest rate of 5%. So 450,000 into 5%, we are going to have 22,500. So the total is going to be 12,500 over here, right? So that's going to be the answer over here, right? Okay, so this is the approach that we have to set over here. I'm going to stop over here now. Next time when we are going to meet on the Wednesday, we'll start with the section C type questions of this, right? And then we'll move forward into this, right? Meanwhile, if you come across any problem or something, feel free to ask me. I will be more than happy to assist you and guide you, right? And I hope your preparation is going well for this subject as well. All right, so time to say bye. I am going to see you on Wednesday now. And till then, take care of yourself, your family, friends, and the people around you. Have the lovely day tomorrow as well. And let's meet on the Wednesday and then move forward. Till then, take care. Bye bye.